When a sector gets really hyped up, you typically see gamblers coming in and overpaying for calls in hopes of making huge returns in the bull market. Well, I am selling them those calls. And in this video, I'm going to show you how I'm making 100% annualized return selling covered calls on the uranium producer Cameco. Because as we speak, uranium has shot way up in price, and we're starting to see those people come in overpaying for these calls. As always, this isn't investment advice. This is just what I'm doing with my own money, and always do lots of your own research before investing any of your hard-earned money. Okay, so here's what I did. I bought 100 shares of CCJ, that's Cameco, for $4,387. And I immediately sold one call, or one contract, and one contract equals 100 shares. So basically, I'm selling somebody the right, but not the obligation, to buy 100 shares of Cameco on or before a certain date at a certain price. So that date is January 12th, which is 16 days from the date at which I sold this call. So the person buying the call only has 16 days to exercise the contract. And the strike price was 44. And when I bought the shares of Cameco, the price was $43.87. So I'm giving somebody the option, but not the obligation, to buy 100 shares of Cameco from me for $44 each on or before January 12th. So what do I get in return for this? Well, I immediately receive in my brokerage account $138.34 after fees. So that is a 3.15% return in 16 days. And in the meantime, the stock can go up a little bit from $43.87 to $44 before I'm going to be forced to sell my shares. So what happens next? Well, this $138.34 is mine to keep no matter what. This is the options premium that the buyer of the option paid, minus any brokerage fees. So over the coming days, the stock price will fluctuate. It will go up and it will go down. But what matters is where it's at on the day of expiration. Because typically, the owner of an option will never exercise that option while there's still time value left on that option. So they won't exercise the option or buy the shares from you until the last day. Now, sometimes it can happen differently if there's like a dividend coming up or something like that, but almost all the time it's going to work like this. So if CCJ Cameco is below $44 at expiration, I'm going to keep the 100 shares. And remember, I have this $138.34 that was immediately deposited in my brokerage account the moment that I sold that option. And the other alternative is CCJ is above $44. And in that case, the owner of that option is going to exercise their right to buy those shares at $44, in which case I must sell them to that person for $44. And in that case, I'm going to pocket $4,400 from the sale of those shares, and I still have this $138 that I received from the sale of that option. And what I'm describing here, what I'm doing, it's called a covered call. And it's covered because I own 100 shares of Cameco. I'm not selling any rights for people to buy shares from me that I don't already own. So for every one contract that I sell, I have to own 100 shares of that stock for it to be a covered call. Now, technically, you could do this without buying the shares first, but then you're selling something you don't own. And in that case, you're increasing your risk a lot. And if the stock price runs way up, well, you're going to have to buy those shares at the much higher elevated price and sell it to that person who bought that option. As the late Daniel Drew said, he who sells what isn't his'n must buy it back or go to prison. But in the case of covered calls, you're not selling what isn't his'n because you own the shares, right? When I employ this strategy of selling covered calls, I like a few things to be happening. One, I like it to be in a hot sector because when the sector is hot, you typically have gamblers coming in who are overpaying for these calls. Number two, I typically like it to be a more volatile stock because the higher the volatility, the higher the options premiums are. And number three, I'd like it to be a stock that I want to own anyway, because if the stock price goes down, well, I'm going to be stuck holding that stock. So if it's a stock that I would have bought anyway, I'd be happy to buy it in order to sell a covered call. By the way, if you find videos like this helpful, please hit that like button so I know to make more like it. Okay, now I'm going to show you a tool that I like to use to calculate what type of profits you can make from these option sales. So I go to optionsprofitcalculator.com. And then here I click covered call. And then I'm going to put in the symbol. And then it's going to automatically get me the current price. And keep in mind, the numbers will be different than what I just showed you because there has been a day of trading in between. So this is going to be changing every single day. So right now, the cost to buy 100 shares would be $4,326. And then you're going to write the call. Write is the same as selling a call. And selecting the option. So it's currently trading at 43.26. So I'm going to select one that's a little out of the money and the same January 12th expiration that I bought. So this is going to be 15 calendar days from now at 43.50. I'm going to click the mid between the bid and the ask, one contract, and a lot of numbers are going to show up here. So I like this website to show me how much I could possibly earn from selling that call, and also at what point is my break even. So for example, here, if the stock price at expiration is at 43.50 or above, I'm going to earn 3.5% in 15 days. But if it's below 43.50, well, then you can scroll down here to see how much your total profit would be on that. And the break-even point on this one is right around $42.10. And keep in mind, we're buying the stock at $43.26. So as long as it's above 42.10, you're still making money. So the stock can actually go down in the next 15 days and you can still make money because you got that option premium. So why would somebody buy this option? Well, they're getting the right to part of the upside of the stock. So for example, if the stock went all the way up to $45 in the next 15 days, you would still only make 3.5% on your money. I say only, but that's a significant return in 15 days. But because they bought that option from you, they get to keep the difference between the strike price, $43.50, and where the stock is at, $45. Thanks for watching. Please subscribe to the channel and next watch this video on why I do not buy options. And whenever I do deal in options, I am a seller.